So I'm going to go ahead and so just to talk about passive activity loss rules. Before 1986, it was like the wild, wild west of the tax code because you could be a doctor or an attorney or a CPA, whatever, and invest in real estate and use the losses from your real estate to offset your profession income. So the joke used to be if two doctors buy real estate together, what do you call it? A tax shelter. Because they would just use the losses from the real estate to offset their practice income and pay nothing in taxes. And so Congress eventually put a stop to this in 1986, where they came up with two buckets of income, passive and non-passive income. And as we know, real estate professionals have probably some of the best lobbyists ever. And so that's where what's called real estate professional status was born. And this trips me up all the time because I speak in front of realtors, agents, brokers all the time. And there's still people who don't know what real estate professional status is. If you're one of those professions, you need to know this because if there's a part of the tax code that favors rich and wealthy people more than this, I don't know about it because it allows you to use the losses from your rental properties and offset your active or earned income. But let's talk about passive losses and how they work. So this is kind of a snapshot of my 2022 tax return. So I had a long-term rental that brought in 10 grand a year. I sold another property for $70,000. I have a laundromat that's considered passive to me that brings in 20 grand. And I bought a short-term rental, or I bought another investment that I'm able to generate $100,000 tax loss on. I'm able to use that $100,000 loss to offset the income from the other investments. And so even though I had $100,000 of income hit my bank account last year, I paid taxes on none of it because I had enough losses to offset the income. Just a high level here.